Buongiorno signore e signori, sta entrando il Presidente della Repubblica Italiana.
Good morning and welcome to the closing roundtable of the second edition of the Strategic Forum that has been organized in Italy. It's a great honor and a great pleasure to have, of course, this roundtable in the presence of the President Napolitano, and we are all very grateful to him for his participation. It's really a great honor. You know that this forum has been set up thanks to the contributions of the International Economic Association when Joe Stiglitz was the president of the association, the International Statistical Institute, I'm a member of the council, and then with the support and the cooperation of the OECD, who has established a commission on the measurement of social progress and economic performance. And then, of course, the support by AF and Bank of Italy, who are hosting this event, and very important sponsorship by SAS, who is supporting financially this effort. We had 2 days, 1.5 days of very intensive and interesting discussions around the idea of how to measure and to improve environmental, social, and economic sustainability and equity. Equity, intragenerational equity, but also intergenerational equity. And this is an issue that, of course, is debated all over the world, and we try to identify hypes in some cases, but also needs for new measurement tools to improve our understanding and, of course, improve policy making. In fact, the 3 key outcomes of our discussions yesterday or today, I would summarize as follows. First, we still have to improve our measurement systems, especially to understand these intragenerational and especially the intergenerational effects of our policies. We still are too focused on outputs, current outputs, without looking at the long-term implications of our choices. Second important point, we need to integrate much more the economic, environmental, and social dimensions, developing new measurement tools that can help us in evaluating trade-offs of these policies. And the third point is, of course, that we have to rethink our policies. And also, as we discussed yesterday, our understanding of how developed and developing countries can improve their policies using the Sustainable Development Goals that the UN will define next year as an overarching objective. For the first time next year, we will have a common agenda at the world level, so it will be a big challenge, of course, both for statisticians and for economists and sociologists, all those who were represented here over the last 2 days to support these new ideas. So this roundtable is aimed at passing on some key messages, identifying, again, challenges, because we hope to have a third strategic forum next year, and a long series of fora in the future. So this is a work in progress. I'm very glad that we have very, of course, distinguished speakers here. And we have in particular Professor Joseph Stiglitz, a Nobel Prize winner and very well-known economist around the world, Ignazio Visco, the governor of Bank of Italy, and also very well-known economist, I would say, around the world. And we were sharing the time at the OECD when he was the chief economist. Martine Durand, the currently chief statistician of the OECD, and very committed to take this agenda forward, and then Ravi Kanbur from the Cornell University, who is an expert in these fields. We have a very precise timetable, so I would immediately give the floor to Joe Stiglitz for the first intervention. We will have 10 minutes maximum interventions, and then a second round, then we will conclude our roundtable. Joe, please.
Okay, well, thank you very much. For this opportunity to discuss what is an extraordinarily important topic. The work, in some sense, grew out of the Commission of the Measurement of Economic Performance and Social Progress that highlighted the deficiencies in our measurement tools, the way we assess how well economies do, and with the recognition that how we judge ourselves, the statistics that we use inevitably influence policy a great deal. So that it is really important to get better metrics. My remarks today are going to focus mostly with some problems associated with assessing sustainability, and particularly with assessing the impacts of economic downturns like recessions, like the policies that are currently being pursued in Europe. So the background is our commission focused on the importance of sustainability. Everybody recognizes that. And the importance of the concept of wealth as a measure of sustainability. That is to say, if the wealth of a society per capita is going up, then it is able to ensure that future citizens will be able to have the same level of income per capita, consumption, standards of living that the current generation has. We noted that there might be significant problems in the valuation of assets, for instance, arising out of bubble prices in housing, and that there were a number of other problems in assessing measures of wealth. And because of these problems, they may not adequately reflect sustainability. Just as an example of that, a lot of attention has recently been given to the work of Piketty, where he's talked about the increases in wealth income ratios that have occurred in many countries around the world. But the interesting thing is, if you look more carefully at the data, and this is partly on the basis of work that's been done at the OECD, that it turns out that at least in those countries where we have detailed data, most of the increase in wealth is a result of the increase of the value of land. And if you look at what's happened to the value of the capital stock as we normally think about it, productive machines and equipment, in some countries like that we have data, like France, that number is going down. So the increase in wealth is more than 100% accounted for by the increase in the value of land. So it's very nice that rich Russians are enjoying the Riviera and paying lots of money to have nice beach houses in the Riviera, but the wealth of the country, in some sense, has not been increased. The amount of land on the Riviera is fixed. That has not gone up, and the amount of productive capital has gone down. And that helps explain some of the anomalies that arose in his analysis, because his analysis suggested there was a huge increase in the capital income ratio, but wage rates continue to go down or stagnate, and interest rates have not come down. And almost all the standards and models in economics would say if there is such an increase in capital, interest rates ought to go down and wage rates ought to go up. But the answer is capital hasn't gone up. It's all valuation and land. And one has to think about why that is, and this is not occasion for doing it. I think it's largely because of central banks and banks, that they are the source of inequality in our society by the mechanisms by which they create credit and who gets access to credit. But that's another topic, and it's a very big topic. But what I want to explain here, talk about, is another issue, and that's the other side, that our accounts are not really taking into account the destruction of capital that is going on in many countries around the world, in particular in European countries, as a result of the recession. Recessions destroy capital or impede its accumulation. We trace out the consequences for plant and equipment. We look very carefully at what's happening to investment, and we can check what's happening to the capital stock, the real capital stock. But we don't adequately trace out the consequences for other forms of capital. Now, I'm going to suggest a broad framework for thinking about this missing capital, and I'm going to try to argue it's a big number. It's a first-order number, and that we ought to begin a research program to figure out what it is. So one way to think about this is the following. If you extrapolated the growth, say in Europe, from 1980 to 2008, very steady increase in growth. There was a few wiggles, but now extrapolate that steady growth from 1980 to 2008 and go beyond that to 2014. What do you discover? Well, you're not surprised that Europe today is about 17% below where it would have been had there not been a crisis. And what you see is that number is getting bigger. The gap between potential and actual is getting larger. And we know from previous studies in economics that the technical term here is that the economies exhibit close to a unit root, which means that if we look forward, say 40 years, 30 years from now, the likelihood is that Europe's GDP will be 17, 20% lower than it would have been had we not had the crisis. The effects of crises are long-lasting. So you ask the question, you write down a standard production function, you think about this. The people in Europe are the same, pretty much. A few people have moved to Australia, but relatively, mostly it's the same people. The same educated people. They have basically highly educated, so the resources are basically the same. The land is the same. We can calculate the decrease in the investment, in the capital stock, because there's lower investment. So we can decrease that. The question is, how do we account for the difference between where GDP would have been and where GDP is? That's a huge number, and that's what we can account for some of that by decrease in capital, in the capital stock. The rest is what I'm going to call missing capital. It's a residual. And what we want to do now is to parse out what are the sources of that. And much of what we've been talking about in the last day has been related to that. It's an enormous amount of money. Depending on the discount rate, we're talking about numbers like $30 to $100 trillion. And that's a lot of money, even for a central bank. And I said, let me make it clear, it was trillion, I said, not billion. So this is a lot of money that's been wasted, destroyed as a result, and our national accounts don't take into account. So we can start looking at this through a bottom-up approach We can look at the loss of human capital, the fact that people who lose jobs get a lower income. We can look at the effects of education. People don't go to school as long. There's been a cutback in the reductions in the quality of education as governments cut back in funding. There is reduced access to health care and nutrition, and these reduced access to health care and nutrition can have lifelong effects. We had discussions yesterday about the destruction in social capital. So there's an important agenda, first to try to quantify the magnitude of what this missing capital, and it's a first order effect that we haven't talked about. And then secondly, to parse it out to see what is the nature, to what extent is it human capital, to what extent is it social capital, how can we attribute it? Some of it is job experience. The existence of this missing capital is consistent with the hysteresis effects associated with extended periods of unemployment, the fact that once the economy is down, it doesn't recover, and it helps explain why the effects of downturns persist with strong policy implications. The long-term consequences of not taking strong countercyclical policies are very serious, and we focus on the short-run effects. We're aware of the short-run effects. We're aware of the effects it has on people today, but we aren't taking into account in our national accounting frameworks the long-run consequence. So as a further example, we talk about the debt, one side of the balance sheet. We aren't talking about the destruction of the asset side, this missing capital that would have been there that we are destroying, whether it's social capital or human capital. And in a sense, the consequence of this economic downturn in Europe are far more serious than has been publicly acknowledged, publicly discussed. This is another example of why metrics matter. What you measure affects what you do. If you focus on the liability side of the government, one may take actions that result in the liability side of the government improving, but the asset side of the entire economy getting worse, undermining sustainability. And it's also an important cautionary note in the interpretation of wealth-income ratios and the implications of these increases. Thank you.
Thank you, Joe. I think that one of the key messages of these discussions, these 2 days, is that for years we have focused a lot on the environmental sustainability and the concerns are there, but now we are much more worried about the social unsustainability. And this is what I think also other speakers will talk about. So it's now turn of Ravi Kanbur.
Well, thank you, Enrico, for putting me after Joe Stiglitz. So how do you follow Joe Stiglitz? I want to emphasize some of the points that Joe made, and most of my work is in the developing country context, so I'll bring that perspective to bear. So we're being asked to consider the long-term consequences of sharp reversals of fortune. And in effect, we're being asked to consider whether there's a strong asymmetry between the downside and the upside of the trajectory of economic and social variables. And so what's the theory and what's the evidence is really the research agenda in front of us. And I think both theory and evidence up to now suggest that there is an asymmetry, and we should be looking at it very carefully. And I'm going to be looking at 3 examples of this, one in the context of health, secondly in the context of ethnic tensions, and thirdly in the context of personal well-being. Now, in terms of health and nutrition, Joe already alluded to this. If you take, it comes out most clearly in a developing country context. Take an agricultural household, which is on the border of survival, and there are good years and bad years. There's drought years, good years, drought years, good years. And it's very clear, the evidence shows in terms of child development and so on, that the drought years are not made up by the good years. You can have a whole sequence, and in fact, on brain development, child cognition, and so on, these effects persist over time. And I think we're finding the same evidence in the developed country context, also through the work of James Heckman and his collaborators. So I think that's the first point in terms of health, strong, persistent effects. My second point is to do with social tensions, and in particular, ethnic tensions. And there are 2 dimensions. Let me give you an illustration of this. In 1997, with the 1997 East Asian crisis, if you look at Indonesia, all indicators, all macro indicators were doing very well till 1997. Actually, all distributional indicators were also doing very well till 1997. Inequality was falling, etc. The crisis hit, and within a few weeks, different ethnic groups were killing each other on the streets. Okay? And in fact, if one looks at the political economy of this, it took several years for this thing to unwind. It wasn't just that it happened, and then when things were good, it went back. It took several years for it to unwind. And I think there are two parts to this which I think are relevant even for developed country context. Firstly, the downturn magnifies ethnic tensions between the majority community and the minority community. That bit we know, that bit is well established in the data. But the bit which is not well established and needs to be researched is the persistence of these increased tensions over time. And I think there are at least two reasons why this might be happening. Firstly, when political entrepreneurs use this downturn to crystallize differences between communities, to use those words and those characterizations, that crystallization is difficult to decrystallize over time. The second mechanism, I think, is that the majority parties, the mainstream parties, react to these extreme parties by, in some sense, incorporating some of their platform onto their own. That you see all through Western Europe, certainly. So, in fact, when the recession goes and maybe these extreme parties disappear, you find bits of their program still in the majority parties, in the mainstream parties. So I think these are the mechanisms through which a reversal of fortune, a short-term reversal of fortune, can be maintained over time. But this is the bit where I think we need more research and more analysis to see how the persistence of these attitudes carries on. So that's my second point about social tensions and ethnic tensions. Now there's a third area which I also want to emphasize, which I think is somewhat more technical. It's to do with how individuals perceive their own well-being when there's been a recession. And I'm going to rely on the work of another Nobel Prize winner, Daniel Kahneman, who in his prospect theory essentially put forward the following perspective, which is that individuals evaluate their well-being relative to a reference point. And relative to that reference point, falling off from that reference point is much more costly in terms of well-being than rising. There's an asymmetry built into that, and there's plenty of psychological evidence and so on, which Kahneman won, and Kahneman and Tversky, and Kahneman won the Nobel Prize for this thing. So now consider the following situation. You're in a normal state, the recession hits, so there's a very sharp fall, and you go down the Kahneman curve to have a very low level of well-being. But the recession then persists, and this becomes a new reference point. And now there's an upswing. And actually, the upswing is on a much less steep curve. So in fact, there's a fundamental asymmetry in terms of well-being that is built into that particular view of things, that actually having a recession and then an upswing will not restore individually perceived well-being to what it was before the recession. So I think those are three examples, ladies and gentlemen. Firstly, nutrition and health. Secondly, ethnic and social tension. And thirdly, how individuals themselves perceive their well-being. In all of these, there are significant asymmetries. We have some research which supports it, and we should have more research which further analyzes these things. But I think if these asymmetries are there, then that's all the more reason for avoiding recessions in the first place. Thank you very much.
Thank you, Ravi. And indeed, the data that now are available on subjective well-being allow many more analysis than from the past. And indeed, these results, these long-lasting effects of recessions are getting more and more well-known and are quite worrying indeed. Now, Martine Durand.
Thank you very much. It's an honor for me to be here today and to speak on behalf of the OECD, who is one of the sponsors of this forum and meeting. So what I would like to do today is to show you, to illustrate what Joe just said with pictures, so that what he said, I'm going now to illustrate like if we were in a movie and now we see the pictures. We've heard the story, now we see the pictures. So the short-term impact of the recession on people's well-being, both material and non-material, have been well documented, including in a special chapter that we published in our report, How's Life in OECD Countries, that we released in 2013. For instance, if you look at the euro area, you can see that household disposable income, which is on the left-hand side of this chart with the dotted blue chart, has held held up rather well at the beginning of the crisis due to social stabilizers such as unemployment insurance, social assistance, and so on. But since 2011, it has declined faster than GDP in a number of countries in the euro area and in the euro area altogether. This is not the case in the United States, where you see that there has been an increase now pickup, and income of households is actually higher than it was before the crisis. But that's only part of the story, because yesterday we spoke a lot about economic vulnerability. And in the US, if you look at what's happened to wealth for the households, the very recent data that have just been published show that for the median household, wealth right now has not come up at the same level as before the crisis, and it's just 1.7 times the level of income. So if there is a problem, another shock, then there is little financial buffer for US households to actually react and use this buffer for spending, for instance, and other things. Whereas for the richest household in the US, you do see that their level of wealth is now higher than before the crisis. At the same time, and this gives us some idea of what happened in terms of broader terms, in terms of income inequality since the crisis, something that was mentioned earlier. In fact, inequalities in market income have increased significantly since the start of the crisis in almost all, more than 3/4 of OECD countries. And if we looked at relative poverty, the rates of relative poverty in OECD countries has also increased and is now effective 12% of population on average. Of course, this increase in income inequality, market income inequality, have to some extent been mitigated by the welfare state, but there is a lot of concern now that as fiscal consolidation takes hold, whether this is going to continue. So with households under budget pressures and the budget fiscal pressure as well from government, more and more people are saying that their well-being, subjective well-being, they are dissatisfied with their lives. And that is along the lines of what Professor Kanbur just said. If you look at people's life evaluation, it plummeted in the countries that were most hit by the crisis. In Greece, for instance, which is a red line here, you can see a strong decline in people's happiness or subjective well-being. Even in Italy, you've seen a big decline, and in Spain as well. So, but can we say something about the future? Well, yesterday we said, and Enrico mentioned that today, said, well, if we want to see whether these effects are going to be long-lasting, that we have seen in the short term, what can we say about those long-lasting effects? We say, well, let's look at the drivers of well-being in terms of capitals, in terms of different forms of types of capitals: economic, natural capital, human capital, and social capital. Well, I would argue that there is a convincing case that can be made that some, perhaps not all, but some of the effects of the crisis will be lasting and very difficult to reverse. With respect to economic capital, the financial crisis and the recession, of course, have led to build-up of public debt, as we have heard this morning, and that will take some time to unwind. But as the build-up in public debt occurred in response to cover private or sovereign financial losses and not as a consequence of productive investment, you can see the effect here of what happened to investment, actually. Investment has not recovered from its level, as Joe said. In the euro area, it's quite dramatic, but still in the US it's recovered, but not to the pre-crisis level. The US Federal Reserve Board recently, in a very recent paper, argued that the level of potential output in the US is now 6% lower than before the crisis, with much of the effect due to this lower investment, lower trend productivity, suggesting that the demand effects have diminished the productive capacity of the economy. So at the OECD, we've also done work on the effect on potential output, and they point to similar long-lasting, long-term effects of lower potential output following the crisis. But let me move on to something which has been the subject of our discussions over the past 2 days, beyond the economy. What happens beyond the economy? Well, something very interesting that we've noticed also in some countries during the crisis is that fertility rates have dropped. So people having less children because of their situation. Of course, we don't know at the end whether this will persist, but if it does, and if it has consequences on future family formation, this will deepen the demographic and fiscal challenges of aging also, beside the fact that, of course, it's very important for family and people's own well-being. With respect to human capital, one short-term effect of the crisis has been to encourage young people to stay longer in school, which you can consider is good because, you know, they will increase their human capital. Well, it's true if the education they receive is good, of good quality. That may not be the case because they extend their education, but not necessarily in good education. But we also know that young people have been disproportionately affected by unemployment and employment losses. If you look at the big drop in employment rates in different groups in the population in OECD countries, the most affected by far have been the young people. And this, we know, can have very long-lasting consequences for the future because of this hysteresis effect that Joe mentioned. In OECD countries, and in particular European countries, most affected by the crisis, the low-income families have also cut back on essential spending, sometimes food in some countries, but also some people have foregone medical treatment that they would have needed, but they can't afford it. They can't afford to go to a doctor. They can't afford to buy the medicine. So they simply don't get the medical treatment. And here you see that in some countries, and in particular Greece and Portugal, we have seen an increase in the unmet needs in terms of medical treatment. So with respect, and I'll stop there, with respect to social capital, the long-term effects are perhaps more ambiguous, which is interesting, because on the one hand, there is evidence from the crisis that people within the communities, within their households, they've looked for support. In the US, 20% of households that have lost their home have gone to live somewhere in the home of their families. So the family has supported the other members of the family. Or in the community, people have volunteered their time during the crisis. And so we see that informal support has increased, which is a form of social capital, which has increased during the crisis. On the other hand, this other form of social capital, which is trust in government, has declined dramatically during the crisis. And this is what we see in this slide. And this can be very important for the future as well, because the percentage of people who declare that they have lost confidence in their government to solve their problems will have implications in the way you can actually implement policies to redress the situation if there's no trust in the government. I mean, I'm not going to explain what's happening in France right now, but I think that provides a very good example of the situation. Let me now finish with what happened to natural capital. This is, of course, the recession has lowered the pressure on environmental pressure because CO2 emissions, for instance, obviously in the short term have been lowered. But one could even argue that the recession and high unemployment may have negative long-term effect on natural capital to the extent that they deflect the attention of policymakers on this issue, because you concentrate more on employment and economic issues, and you neglect. We'll see what happens next year at the Paris COP21 conference, but we'll see whether there will be actions taken. On the other hand, on the upside, the crisis has triggered a lot of debate and offered opportunities to pursue models of a greener economy, for instance, as a source of growth, of economic growth. You hear more and more invest in green technologies, and perhaps this is going to be good for environment, but also for growth. We have an OECD Green Growth Initiative, and we're looking at these issues. So as you can see, the crisis has had short-term effects. Some can be long-lasting and having important implications on unequal opportunities for the future, but also in terms of economic prospects. So it's very important that this group continues its work on understanding better, measuring better, and the OECD is very committed to work in this area through a very ambitious project called New Approaches to Economic Challenges. And I'll stop there. Thank you.
Thank you, Martine. And 2 points that emerged yesterday in the discussion and also in other occasions is that the same policy may have very different effects depending on the mood of population. And of course, this must be taken into account by policymakers, because otherwise they are surprised that the policy doesn't work, but the psychological condition. And also, Mario Draghi yesterday underlined the fact that unless there is confidence in the future, it's very difficult to have a recovery in Europe. But of course, the other question is, how can we manage a democracy that doesn't grow? This is, at the end of the day, the big question that is emerging in several countries. Now we have Ignazio Visco for his considerations.
Thank you very much. Well, we will have a few minutes later to exchange views about what each one of us has said. My starting point is that the legacies of the Great Recession are many and multifaceted, and certainly not only they affect current economic developments, but also they may have permanent bearings on the economy. However, today's difficulties and opportunities, as well as tomorrow's prospects, I think, are the result of deep underlying forces that were already reshaping the function of the world before the Great Recession began. In advanced economies like the US and the UK, output, GDP, as badly measured as it is, recovered last year to pre-crisis levels. So this has not yet taken place in Europe. As a matter of in continental Europe, as a matter of fact, maybe projections point to the end, towards the end of next year, to have these back in place. And it should also be underlined that the weak recovery in our area is no longer confined to stressed countries. It really hits also countries which are not really under stress. What I think is most worrying about the crisis is that it may be leaving us with lasting scars. There is a high correlation between the increase in how badly estimated output gaps since 2007 and how badly estimated potential growth of output, and this suggests that lower investment and higher unemployment may have had an impact, which is more or less permanent, or certainly extending beyond the current cycle. And this is worrisome for a number of countries, for everybody, but for a number of countries really is particularly worrisome, for example, those with high public debts, because at the end sustainability requires many things, but also requires a return to a steady economic growth. And these countries may also suffer, as is presently the case in the euro area, from excessive disinflation. This is why structural reforms and accommodative monetary policy are so much in demand nowadays. Now, that the legacies of the crisis go well beyond the short term is very well epitomized by ongoing talks about the risk of hysteresis, and Joe mentioned those, but also by the discussions taking place around the world now, following Larry Summers, of secular stagnation. Secular stagnation is an hypothesis that was introduced in the 1930s by Alvin Hansen. It has been defeated as an hypothesis that is proved wrong, but nobody knows for the future, and there is a lot of discussion about that. There are a number of definitions of secular stagnation. The one that Larry emphasizes is the fact that saving is high, investment is low, and at the end monetary policy is unable to make the two equalize through sufficiently low interest rates because there is a lower bound. There are also others who say that really the problem with secular stagnation has as its roots the declining productivity growth that has been resumed in the US, especially as a result of the fact that everything has been invented and not much is there to be invented. There are also critics of this version, I'm among them, who reply that the digital revolution has yet to deploy its full effects on productivity, and that the potential from frontier research in robotics, in genomics, and so on is pretty powerful. But this really brings me to the issue of technology and to the other major structural forces that were changing the world economy well before the Great Recession. The one that we studied at the OECD when I was there and Martine and I were working together. That is globalization and the demographic trends. It is true that fertility has been decreasing, but it was decreasing already in advanced economy much before the Great Recession started. So this must simply be the continuation of a trend, not really an acceleration. Anyway, the labor market is where we can best see the intertwining effects between structural changes and the effects of the crisis. The latter has resulted in dramatic increases in unemployment. We have seen unemployment rates really increasing to double digits, and then in the US and the UK they have been reduced. Now we are around 6%. In Europe they're still at 11.5%. And they are not really falling down. And in Italy, the unemployment rate is about 12%. It doubled since 2007, and youth unemployment is particularly high. There is also, however, a broader issue here, and the fact that we see a tendency in advanced countries of employment rates to fall. That is, the number of employed over the population working age is falling also in those countries which had a substantial reduction in unemployment. This tells us something, that is something structural is going on there. The long-term unemployed have doubled in Europe. This is more or less what we understand. And between 2007 and 2013 in the US, the employment out of the working age population fell from 72 to 67%, 5 percentage points. In Italy, it was from 59 to 56%, and from 25 to 16 among the youth. Now, the critical point, I think, here is to what extent the rise in employment is therefore structural or cyclical. And in principle, fighting the former is more difficult than sustaining aggregate demand, because you need to pass through a substantial reallocation of labor across sectors and across countries. And this is clearly very difficult. And many displaced workers may find that their skills are no longer in demand in the aftermath of the crisis. This adds to the problems in perception and so on. Now, technological progress has, in the last 2 centuries, generated a widespread wealth and new employment opportunities. The question is whether we still have these kind of prospects in front of us. Uncertain. I think this is one of the periods in our history in which this may not be true. And I think the technological unemployment, which John Maynard Keynes and Mead, for example, talked about, this time is something to be taken more seriously. Now, there are very good things with technology, and most likely there are going to be effects on employment, creating new jobs. But the question is how many jobs will be destroyed as new jobs are being created. And those which are already being destroyed are the routine jobs, are the ones which can be substituted with machines. And there is a polarization somehow of professions that's coming out very clearly in the United States, but also in Europe and Italy. We are observing that to an extent, in which basically as the middle-skill jobs have disappeared, the high-skill jobs are intellectual and where much cognitive efforts are somehow required are increasing, and the low-skill jobs where you need a lot of physical work and so on and not easily replicable with machines are also increasing. Now, there are many things that we may discuss on that, but there is also a somehow discussion which is very important, I think, on the prospective effects in the next 1, 2, 3 decades of further progress in, as I said, robotics and genomics, but also in artificial intelligence, as far as jobs may be somehow affected. And both, in this case, the higher skilled and the medium-lower skilled jobs. Now, given our specialization, this country specialization, Italy has so far suffered the most from globalization, more than from technological change. And the big problem has been the delay with which it has adjusted to the major changes at the world level that we have observed in the last 30 years, demographics, technology, and opening of markets after the fall after the end of the Cold War. There is, however, also to be observed that even this country is not immune to the challenges posed by technology. As a matter of fact, it may be affected even more. There is a study which has been completed last year and published, which is often quoted by some Oxford economists, that say that some had estimated that 47% of current jobs in the United States will be at risk of being automated in a decade or two. This has been replicated by a think tank in Europe, Bruegel, and they came out with figures of 44% in Italy, 51 in Germany, and 50 in France, and so on. Now, these are large figures. Obviously, these are gross. There are many jobs that will be created. The problem is, as I was saying, the net. This leads me to see that we still have to make a major effort in a number of fields. One of these fields is crucial, is investment. Investment is the linkage between today's demand and tomorrow's supply. And this is also really something that policymakers should really look in depth. We have had a fall in investment, in real investment, in the last 5 years in Europe of 20%, real terms, around 25-30% in Italy. Now, this is clearly taking place despite very low interest rates which have been put out by commodity monetary policy, and they have also resented in stressed countries by the fact that access to credit has been difficult because of balance sheet repair in the banking sector, and the increasing cost of capital because of fragmentation in financial sector. But also, I think there has been a major fall in public investment following the fiscal consolidation. Now, this has to be reversed. And it has to be reversed because lack of investment in infrastructures, education, training, and so on is another possible source of secular stagnation. And to conclude, I'd like to say that we are, as far as policy is concerned, is in uncharted territories. Obviously, we need to stimulate investment, and we have to also ask, however, how much this capital accumulation that will come may further save jobs. We have to look for investment that is complementary, not substitute, or we have to also to find a way to widen the cake. Now, macroprudential policy is a major theme in central banking these days. And central banking clearly also has changed dramatically from conventional to unconventional policy, and it has changed because it has kept its accommodative policies, no matter what the risks may have raised in particular sectors, using macroprudential interventions, say intervening directly on credit buffers, intervening on loan-to-value ratios in the housing sector, and so on, to contain those risks. So monetary policy will remain accommodative for that. But monetary policy is not enough. It's not all the game in town. As a matter of fact, it's, in my opinion, a limited game. It affects levels, not rates of growth. It may also perhaps have an impact on rate of growth. We learned when we were students of money and real growth, I mean, Sidrowski, if I remember. But I doubt that this is really a major effect. I think that the main challenge is the real economy, is the business environment, how to make the business environment somehow more conducive to private investment, and how to make investment in infrastructure to return to be high in the policy agenda. Now, in the euro area, I think there are a number of policies which have been identified, very difficult to be put in place, but cost of capital has to be maintained low. The capital market sources of financing have to be improved in order to substitute with reductions in bank credit, and at the same time, different countries have to engineer different structural changes in order also to provide improvements in expectations, perhaps in perceptions of more favorable aggregate demand going forward. All these to improve the investment desires on the part of entrepreneurs, but also you need really to reduce policy uncertainty, and policy uncertainty is pretty high. In our countries, I think we have discussed at length what has to be done. I think it is a wide package of reforms put together, but two of them just we singled out a few months ago: legality and efficiency in the public administration. I said recently corruption, criminal activity, and tax evasion not only undermine the community, but also distort the behavior of economic agents and of market prices. And this way they reduce the effectiveness of government action, increase the tax burden on those who do their duty, and restrict productive investment and job creation. Well-functioning public administration, in reverse, improves the operation of markets and competition, reduces firms' costs, and is reflected in the quality and cost of public services, and thus on the tax burden. The efficiency of the reforms depends on it. And I would just conclude saying that as these policy actions should be part of a fully fledged strategic reasoning on the prospective function of the economy, we have a number of challenges that we are not sure how to deal with that, and we have to better understand. And the challenges are those posed by the structural and technological changes. But some questions we may identify immediately, and I identified three. Some overlap with what has been said. How should the education system adapt to enable the teaching of those skills essential to keep up with new technologies? How can we enable displaced workers to acquire skills which will not become or are less likely to become redundant through computerization? And how can public policies smooth the social impact of technological progress and allow a wider distribution of its fruits? Thank you.
Thank you. Well, you know the famous Chinese malediction, I wish you to live in interesting times, and indeed we are living in interesting times. Short comments on what you heard, and just a little bit more than 1 minute.
Okay. I'll try to be very quick. First, I want to share with you a little bit my perspective, although Europe is worse than the United States. The United States is not in great shape, just to make you feel a little better. And it's highlighted by a couple of statistics that median income in the middle, half above, half below, is lower in the United States today than it was 25 years ago. So there has been over a quarter century no increases in standards of living, and that doesn't make most people feel very good.
In Italy also the average income, but this is
yeah. Since the crisis, about 95% of the increase in incomes that occurred, that was shown in Martine's chart, have gone to the top 1%. So again, Americans, you know, we like these charts showing that GDP is going up. We love that Bill Gates is feeling better. But in terms of most Americans, there's not been a recovery. So now on the issue of unemployment, and this is related to some of the remarks that have been made, yes, our unemployment numbers look better, but there's a lot of disguised unemployment. And that goes to the point that was made that labor force participation is very low, employment is very low. And so when we do the numbers on unemployment, we talk about disguised unemployment, total unemployment, probably being in the order of magnitude of 10%, not the 6% that's the official number. And there are a whole variety of adjustments that one has to make, but that suggests that things are very weak, which is why the Fed no longer uses the unemployment rate as the guide for their policy. One way of seeing this, and why I think, and this is where I think I disagree a little bit, that yes, there is a structural aspect of our unemployment, but the dominant factor is aggregate demand. Because if it were structural, there would be tightness in the labor market of those kinds of skills for which there was excess demand. And in general, we have downward wage rigidity, and you have the average of some people getting bid up and others are not moving down. The average would be going up. And what we see is stagnation in real wages. Real wages have not improved. They're going down in Europe, but in the States, they're not really going up. So I think the problem is basically aggregate demand. Now, can I just say a couple more remarks? Before the crisis, we did have a weak economy in the United States that was covered up by a bubble that was supported by loose monetary policy and deregulation. So The problems were the ones that were already highlighted, that we needed to have structural transformation related to globalization and the increases in productivity in manufacturing. We had to move people from manufacturing to the service sector. The problem is not the zero lower bound. The zero lower bound suggests that if we could only get the interest rate down below zero, things would be solved. In the United States, our real interest rate is -2. Nobody thinks that if we got it down to -4 or -5, our problems would be solved. There's just no evidence of interest elasticities of that kind. If there were, we could get the same effect on intertemporal prices and real interest rates through fiscal policy by a pattern of changing investment tax credits over time and sales taxes over time. But no one's proposing that. So it's not intertemporal prices. The zero lower bound is just a wrong way of posing it. What is weakening the U.S. economy is the growth of inequality. If most Americans don't have money to spend, aggregate demand is going to be low. And that is the fundamental problem that has to be addressed. And monetary policy, unintentionally, is worsening this. And this goes back to the issue of if you have low interest rates, close to zero, for those who can get access to capital, the incentive is to use very capital-intensive technology. So you're using machines like checkout clerks. You're replacing checkout clerks with very capital-intensive machine. What you need is fiscal policy. Monetary policy has reached its limit. You need fiscal policy which can give incentives for more labor-intensive investment. If you have only one instrument, which is the interest rate, you're going to get the kind of things that have happened. And I'm not criticizing the monetary policies for doing what they've done. What I've said, they've done what they've done because the fiscal policy has not been there. So their hands are tied. What we really need is fiscal policy to really get at a recovery with jobs.
Thank you. Sorry. Ravi.
Yeah, so I just wanted to, since there are researchers here, to emphasize the research agenda that I see from the points that I made. Research agenda on asymmetries and persistence, because I think this is the key here. I think we have a fair amount of evidence on asymmetries and persistence in health and nutrition. I think we can be relatively confident on that score, although, of course, more work is always welcome. In terms of asymmetries and individual self-assessment of their well-being in upsides and downsides, we have a lot of micro-evidence. Indeed, Daniel Kahneman won the Nobel Prize for producing that micro-evidence, but we don't have as much in the way of macro-level evidence using things like the World Values Survey and so on asymmetries and persistence. And thirdly, I would say, again, the ethnic tension, I emphasize again, you only have to walk down the streets of any European capital and you know what's going on the streets. We have evidence that downturns intensify ethnic tension. What we don't really have analysis of is the persistence of this over time when things improve. And I think that's a wide open research area for us. Thank you.
Thank you very much.
Yes, I will be very brief. I want to say two things in sort of response both, not in response, a comment to what both Ignazio and Joe said about unemployment and employment situation. I think really this is going to be the key to anything, because in terms of how families see the children and themselves, almost every single family in the euro area is affected by unemployment, either directly because they lost their job or because someone in their households has lost their job. And when they see that the children do not have prospects for the future, although they go to university, they get good education, they cannot enter the labor market, the transition into the labor market is so difficult. I think this is a dramatic situation, and that is also, of course, putting a lot of pressure on the psychology, on saying the future for us, if the future generation don't have as bright a future as the parents, I think this is really very essential in terms not only of well-being, but also for the recovery and so on and so forth. And I think this is really the crux of the matter. Until we solve this unemployment problem and this employment problem especially for the young generation, this is going to pose a problem. But there where I would probably perhaps a bit disagree, I don't think that it is, of course we have to adjust our education systems, we have to make sure that there is more training in companies as well, because if you look at the training spending by companies, it's essentially those who are already highly skilled that get the training, but those who are unemployed, who are on unemployment rolls, don't get to be trained, they don't receive sufficient training and so on. So it's not just education, but it's also training for those who are currently working and that need to adjust to the new conditions, technology, and so on. But I think it's a sort of I would see it that perhaps it's a mistake to think that education by creating or promoting more highly skilled and tertiary education for all, I think we are going to make a lot of frustrated people. So we have to be much more, I think, this idea that we need to have much better data, much better understanding of what's happening at the sectoral level, where are the jobs going to be created, in which sectors, whether services, whether manufacturing, remembering that a lot of manufacturing is actually services. We talk about manufacturing, but it's actually services we're talking about, so that we provide the skills, the competencies on the whole range of jobs, not just for the Nobel Prizes in the brain surgeons and so on, but of course they have to, even if you are a janitor working in a building, you will need perhaps different skills than the skill that you have today, because you would need to be more cognizant of technology and this sort of thing, which doesn't require a lot of changes in our education system. It just requires having people, giving people the right skills to face the new world. But this investment in I think it is probably too much investment in higher education and not enough investment in the education that our children and the future of our economies need.
Thank you very much. First of all, I think, we have to agree on many things, and we should concentrate on what we agree rather than what we disagree. We should be, number one, agree to be humble. And I think we know, each one of us, pretty little. This is why it is very good, this effort that we're making in measurement, in trying to understand more, because this is really crucial. Secondly, I think that among the things which have been somehow underlined, investment is crucial. I agree that I don't know, 30 trillion, whatever, but more or less, if you think the number of years we have been in recession, I think 20% is investment in the economy, and it has fallen 20% in real terms. It is a figure which makes me somehow I agree with. So this is crucial. How to make it happen? It is a different thing. I don't think that the monetary policy has much to do with that. I think monetary policy may have had problems before the crisis, may have been for a while perhaps combined with poor regulation and excessive risk-taking or other things in financial sectors, and therefore produced this aggravation. But it is not to be the solution of a real growth problem. I also think that we should, that I agree that the social issue is crucial. And I also think that there is an issue of income distribution. Not the 1%, perhaps the 0.1%, but still this is extremely wide. If you look at the increase in productivity in the United States and the increase in the average median wage, well, they went apart in the last 10 years. This is a crucial thing. I think this is something that has to be dealt with. Then the issue on education, and I close with that. I think it's correct. It's not to get more degrees, but is what has been said, lifelong learning if you want, and also to understand better how to live in today's world. And one thing that struck me dramatically last year was this data that came out from the OECD on PIAC. PIAC is basically a survey of adult literacy. literacy among the adults, not among the youth, not among those who go to school. And these data are revealing, because they basically tell you how you somehow match the challenges that are coming by today in today's world, the new technologies, new people coming in the countries, new things happening. And we had numeracy and literacy performances that were terrible. 7 out of 10 persons in this country, maybe 5 or 6 in the United States, basically are unable to read and understand a journal article. They are unable to understand from a chart what the chart that you just had shown us, what is the meaning of the chart. So this implies, it's not that you have to educate more, you have to educate better. And this is one of the greatest challenges that we face in the next few years. Thank you very much.
Well, thank you very much to all the speakers. I would just conclude thanking again all the speakers, participants in the forum, and of course, SAS, AF, and Bank of Italy. From my side, let me just point you to 2 readings and events. The first is the UNDP report on human development that was published this summer with 2 keywords, vulnerability and resilience. And the key message is that even if this crisis is over, it's not going to be the last one. So we have to prepare our societies, our economies, better to react to new challenges and changing conditions. And the second suggestion is that on 10th of October, the European Union, under the Italian presidency, will host a conference in Brussels on how to bring this beyond GDP agenda into the European governance. I'm very glad that I had agreed about that when I was minister, and I'm very glad that this will be a celebration of 10 years since the first OECD World Forum on these topics that we organized in Palermo. So we hope to be able to bring these ideas, these new measures, also in the European governance to improve not only current growth, but especially sustainability of our societies. Thank you again.